All right, let's get started. All right, assalamu alaikum, everyone. Thanks again for joining us. My name is Nadeem Mian. I'm the portfolio manager for ShariaPortfolio Canada. With us tonight, first of all, the topic of tonight is retirement planning and the individual pension plan IPP for businesses. With us tonight, our guest speaker is Sarwar Qureshi. He's a CPA, CA. Based in Ottawa. So, we'll obviously hear more about this topic. And this is obviously an important and a high, and the purpose of this is to obviously is for education purposes. In fact, quick disclaimer here, 1 second here. Okay, so just quick disclaimer. Of course, everything that is being presented today is for information and educational purposes only. This is not giving any investment or tax advice. We obviously encourage you to speak to your investment or your tax specialist on any specific questions related to your situation. Also just like to point out that neither ShariaPortfolio Canada, myself, or are affiliated with Sarwar or Patterson and Company. Neither of us are being compensated for our services or anything of that sort. So with that, just quickly, I guess a little quick promo here. If you haven't heard of ShariaPortfolio Canada, we encourage you to download our app. It's a new app. It has all sorts of features, including a Zakat calculator. And it is available on both the iTunes and Google Play. So the agenda for today, just quickly, we're going to talk about ShariaPortfolio, who we are. If you are new to our webinars, if you're new to ShariaPortfolio Canada, welcome. We hope this is not the last time you attend any of our webinars, and hopefully we can speak more down the road. But if you've already previously are familiar with ShariaPortfolio and you've attended our webinar, well, we were welcoming you back as well. I'm going to just touch upon just a quick overview of some of the registered retirement plans that are available here in Canada. And then, inshallah, Sarwar will be diving into the more detailed part of the presentation, which is about the IPP, ideal candidates for that, some of the benefits, and along with the tax advantages. And he'll also be, giving us a quick generic case study on what the IPP can look like and what are some of the advantages. And finally, of course, we'll end it off with just kind of next steps, getting started. If you are interested or if you are thinking about the IPP, what should you do? And then, of course, one of our favorite part of the presentation is the Q&A, which I think ends up being probably the most productive part of the presentation. So ShariaPortfolio Canada, who are we? First of all, our mission, really, our goal is to help Muslim Canadians, reach their financial objectives, but making sure that their goals also adhere to their Islamic values. We're registered in the provinces of Ontario, British Columbia, and Alberta with the Securities Commission of those provinces. Also adhere to their Islamic values. We're registered in the provinces of Ontario, British Columbia, and Alberta. Saladin, can you put your thing on mute? I just heard a recording of myself, but anyways, we're also an exempt market dealer. We have like I said, we're registered in Canada, so we do have obviously domestic clients within the provinces that are registered, but we also have international clients as well, not including the US. For the US, our parent company in the US handles that, and the parent company has been around since 2003. As our name suggests, we are dedicated to Sharia compliant investing. And what that simply means is that we follow an Islamic guideline, which is the IOFI guideline. We subscribe also to various software platforms that help us screen out investments that are haram or halal. We are fiduciary investment managers, so we are service oriented. In other words, we're not here to necessarily, pitch you a product. Our fiduciary duty really is to act, to act in the best interests of our clients. And we also have other financial advisors in Canada too. We have a couple out in Vancouver, who are handling that market. And I myself am based here in the Greater Toronto area in Ontario. And finally, we are partnered up with Fidelity Clearing Canada. That is the custodian bank that we deal with. All the back office, trading, client administration, all that is being handled by Fidelity as a custodian. The online access that we provide our clients is actually via a Fidelity portal as well. And having Fidelity as a custodian also means that our clients do have the CIPF coverage, which is the Canadian Investment Protection Fund. And so they are subject to all the protections that are backed up by the CIPF. So now getting into the topic of tonight's webinar. And by the way, there is a Q&A box there. So I do encourage everyone to, as the presentation is going along, please input your questions. At the end of the Q&A, I'll obviously go back to them and go through them. But as a question pops in your mind, we do encourage you to just put it into the Q&A box on your screen there, then the tab. So first of all, before just getting a fundamental, before we dive into the IPP, because the IPP is more of a complex topic, I just wanted to cover the fundamental basics of the types of registered plans that are here. Now, most people, if you're working, for example, for the government, or you might be familiar with something called the defined benefits plan. That's basically a pension, right? Where you're working for a particular government, and after the time and the years and all that you spent, your guaranteed life income. Right? Everyone kind of understands that. And at the same time, if for a lot of large employers, large corporations, they offer a lot of what we call defined contribution plans, where the employee contributes to the plan, and it's like a group RSP, and the employer will typically match that amount or have some type of compensation as well. So these are two types of plans, and the reason why I wanted to point these out is because most of us, or a lot of us, maybe especially attending us, we don't work for governments, or we may not, be with we may not be an employee of a large corporation, so we don't have the luxury of being in some of these DC or the DB plans. But the most people today, if they're not in a pension, or if they're not in a group RSP, they go into a self-directed RSP, where you are contributing to your RSP and you get that tax break. That's something that most Canadians, I think, is probably the most popular investment account, in Canada. Now, that's for an individual, and the topic of tonight is obviously individual pension plan, and that is how, I guess you can say, is a way for the private sector to actually have its version of a pension. So having said that, I will now introduce our guest speaker for tonight. Sarwar. Sarwar is based in Ottawa and is a partner at the accounting firm Patterson & Company. Sarwar specializes in the business of helping small businesses owners. He is an alumnus of the University of Ontario and obtained his CA and his CPA designation in 2012. He works with a variety of small business clients, which include professional, real estate, construction, and service providers. He is also a part-time professor at the Algonquin College. So with that, I will introduce Sarwar. Sarwar.
Thank you, Nadeem. Assalamu alaikum. Hello, everyone. You might see me looking this way because my daughter is almost broke into the office, but she got distracted by my wife, so we're good for now. So I'm happy to be here, happy to talk about IPPs. What's really interesting about the IPP, I find it's lesser known than the RRSP product. So there's a lot of just knowledge and sharing that needs to be done so people are aware of what it is, and potentially it could be a solution for some people. And the goal today is to kind of just unpack it a little bit and provide some basics around what is the IPP. So just the definition itself, individual pension plan, it's an opportunity for incorporated business owners to basically create a pension plan for themselves. And it is in line with the defined benefit pension plan rather than the defined contribution plan. So Nadeem touched upon that. earlier. And the main difference is the defined contribution plans are the amounts being contributed are in the control of the investor. So for example, with an RRSP, money is being put in, that is within the control of the investor. However, after that point in time, the control then lies with how the markets do, what are the products that are invested in, and what happens from there. If they go up, great. If they don't go up, then that's a bit of a tough situation where the RRSP hopefully can recover. And my dad being an old school guy, he still tells his story about how he had half his portfolio in Nortel shares back in the day, and they went down and never recovered. So unfortunately, the RSP is restricted in some ways because it's defined contribution. On the other hand, the IPP is a defined benefit plan, which means there is a number, a target that the plan will be able to pay out upon retirement to the person participating. So it's almost like there needs to be a certain amount of funds in this plan to pay that out. So, you might have heard something like someone works in the government for a certain number of years, and when they reach a certain age, they're entitled to 75% of their salary upon retirement. That's a very broad summary, but that is something similar to what we are talking about here. So just to get into some of the basics, it's generally for a small business, and it's for the business owner, the controlling shareholder, or specified individuals like the family member. Sometimes we see spouses or kids that are involved in the business participating. The intention is to offer the maximum pension benefits permitted under the Income Tax Act, and there's guidelines that CRA, Canada Revenue Agency, has put in place in terms of what can be contributed to the plan. It's designed to pay out an income stream that is determined by a benefit formula at retirement. So kind of like my example a moment ago, where there's a set calculation where the person participating in the plan will be able to recover or have a pension of a certain amount. And there are calculations being done to ensure there's enough money in the plan to pay that amount out. It just brings a little bit more certainty to the plan itself. The services of a registered actuary are required for the establishment and ongoing service of a plan. So we don't have any actuaries in this presentation. Nadeem and I are both not actuaries. However, we did consult with an actuary, and we are working with actuaries. So any questions for them, we are certainly able to get access to that information. And oftentimes an IPP is referred to as an RRSP on steroids. And what that means is there's just a much higher level of savings that can be put away in an IPP as compared to an RRSP. And we're going to go through an example. And I actually had a client that when they went through the IPP process, maybe a year or two back, they said the IPP felt like a big sister because it was just being able to take care of them a lot better than an RRSP can. So the next slide will kind of show us a quick example of that in place. So this graph is basically comparing the projected fund value between an IPP and RRSP for a member that has 10 years of past service and a $500,000 starting point. So usually when someone considers starting an IPP, they are able to look at what their existing RRSP balance is and bring that amount over as the starting point or roll it into the IPP. So in this case, we're assuming that amount is 500,000. So the starting point is the same. Now, the big difference in terms of the blue line and the red line is, firstly, both the IPP and the RRSP, we are assuming return 6% per annum as far as rate of return goes. However, one assumption that we've made is the IPP, if there are expenses associated with the investments, and we've assumed that the investments have a fee of 1.25%, the IPP can pay for those expenses outside of the investments. So the fees for the investments are charged separately, and they are a deductible expense to the company, which is a huge benefit. Because on the other hand, with an RRSP, because it's a registered investment, the fees on a registered investment like an RSP or TFSA are not deductible. And secondly, normally those fees are deducted directly from the fund itself or the balance, the portfolio itself. So normally the 6% return in an RRSP would be reduced by 1.25% for the investment expenses. So now there's this spread where the IPP is able to generate more money because the fees can be paid separately and they're deductible, whereas the RSP is not. And then the second big benefit of the IPP is the contributions are significantly higher. And as a result, the investor or the owner is able to put a lot more money away to the tune of, it's almost double what they have at the end of the day when they are looking to retire or pull funds out of their IPP. So that's a simple example to show the difference between the two. Now, moving into the next part, the question often comes up is, who is the ideal candidate for the IPP? So normally we are looking for people that are business owners. So if someone is an employee of a company that they are not the owner of, they're probably not the right candidate yet. They might be an owner one day and they can revisit it at that time. Normally, these people are around age 40 and older. And the reason is the IPP contributions really start to exceed the RRSP contributions around that age. Prior to that age, if there are people that are younger than that age, usually the recommendation is to focus on the RRSP and save the money there. Because as I mentioned, if they decide to pursue the IPP at a later date, those funds in the RRSP can be rolled over into the IPP at that point in time. Generally speaking, these people are high income earners, $150,000 and more. And one of the reasons we consider the IPP for some people is the RRSP is very limited in terms of how much can be saved there. Like generally speaking, on an annual basis, the limit these days is around $26,000. And for some people, that limit is not sufficient for the amount they'd like to save, and it's not sufficient for their spending habits in retirement. So sometimes they need a bigger balance for what their lifestyle entails and how much they'll need. So generally they're a high income earner. And I would also add to that, usually they're a high spender and they will continue to be in retirement. And that's why the IPP having more funds available is useful. If the person has been an employee of their company and has history, ideally, they've been a salaried employee for 10 years, then that helps immensely, because what happens is at the start of the IPP, the basis for how much they can contribute is based on their past employment history, and how much they can contribute going forward is also based on their employment on a go-forward basis. So oftentimes, if someone is on a salary, we can work with that more easily. If someone has not been on a salary, for example, they've been utilizing dividends historically, then they might not have the same, it's called pension adjustment calculation or past service calculation, that this person that on a salary would have. So they would not be able to get the same big lump sum contribution opportunity. But in any case, they can still go through the process of being converted to salary so they can participate in the IPP going forward. And then the last piece is succession planning. So one of the really nice things about the IPP is that it is a creditor proofing mechanism. And what that means is the contributions into the IPP belong to the plan holder, not the corporation. So now they've been able to move funds from their company into a pension plan, and that pension plan is for the benefit of the individual, and it is separate from the corporation. So they're able to do some creditor proofing. And also, if something happens to that individual, the plan can be transferred to their spouse, to their beneficiaries, like their kids. There is the ability to move that plan so other people can benefit from it if something happens to them. So let us go to the next one, Nadeem. So some of the benefits I've already covered off, but just to kind of recap, there's a larger tax shelter for IPP versus RRSP. So what that means is the funds that are being invested in the IPP are tax deductible for the corporation. So the corporation is getting a deduction for funds that go into the IPP, and those funds are now going into an account that is building in value for the benefit of the individual. So it's basically moving corporate dollars out of the company into a plan that's for the benefit of the individual. The IPP is also tax sheltered. So all that growth that's happening inside of the IPP, dividends, capital gains, things like that. All of that is accumulating on a tax deferred basis, similar to an RRSP, where the funds are kind of accumulating and there's no income tax being attributed to them at that time. It's all tax deferred, meaning when it's paid out, that's when it kicks in. The 100% creditor protected, I think I already mentioned. The pension transfers to spouse or beneficiaries upon death, I already mentioned. All fees are tax deductible and company can pay the investment fees. So I mentioned this earlier, just to recap, the fees for the funds being invested, normally the portfolio manager or the investment company would charge a fee. That is payable by the company in an IPP scenario and deductible to the company. And that is advantageous because in the RRSP scenario, if there are fees being deducted, normally fees inside of an RRSP are not claimable by an individual. So there is this difference between the deductibility of funds, fees, sorry. And also there's sometimes additional fees with the IPP as well, like the actuarial involvement. So those fees are also deductible. And the funds, they can be moved from a company to personal on a tax deferred basis. So basically the company has this money, it's being moved to the pension plan, which is for the benefit of the individual. And it's all being done on a tax deferred basis, meaning the company is getting a deduction today. The funds are now accumulating in value on a tax deferred basis. And the individual will only be dealing with tax when they start to withdraw funds from that plan. But if that runway is for a number of years, there can be a significant amount of growth that occurs that's tax sheltered. And the last point here, which I think is also an interesting one, is the company can top up funding. So because this is a defined benefit plan, there needs to be a certain amount of funds in the plan to guarantee the individual will be entitled to a certain amount of income when they retire, defined benefit. So the amount that they get is defined. So in my example earlier with my dad, losing a bunch of money in Nortel, if let's say that was an IPP situation, the company would have the option to make a contribution to top up what is missing if that plan is underfunded, to get that plan back on track. And that would also be a tax deductible contribution to the company. Whereas on the other hand, if you invest money through an RRSP and your investments lose money, that is basically a decrease in the value of your RRSP, but you do not actually get new contribution room. Unfortunately, you are still stuck as having used up that contribution room in the past. So the top-up opportunity is a bit unique with the IPP. So I think we have a case study. So we went through a basic scenario to kind of illustrate a couple examples and show a couple different figures for how the IPP and the RRSP can differ. So in this case study, we have a 55-year-old business owner, it could be Mohammed or Amina, and they basically have built up a significant amount of wealth through their company. So they've had some successful years in their company, and their company has built up excess cash as a result due to the successes that they've had. They've been paying into their RRSP historically, and they've been paying themselves a salary to continue to generate new RRSP room. But their fear is based on their lifestyle that the RRSP isn't enough in two ways. One, it isn't enough in terms of how much they'd like to save today. They'd like to be able to put more money away, but the RRSP has its restrictions on limitations of dollars you can put in. And two, they're worried that there's not going to be enough in the RRSP when they retire, that based on their spending habits, there's not going to be enough money in that plan when they start to pull it out. So they're thinking, is there something more that we could do in addition or to enhance the RRSP so that we can have more money to put in, so we can utilize some of the cash in the company and have more money available to us in retirement. And then if that's how the conversation is going, based on the presentation so far, you can imagine that setting up the IPP will allow them to make larger contributions and have a much bigger balance available to them in retirement. So we have some numbers on the next slide, and you'll see in the numbers a couple of different examples or a couple of different trends kind of emerge. So we have the left-hand side and the right-hand side. So I always hate when there's too much information on a slide. So let me try to make sure that it's very clear and you don't feel overwhelmed. So on the left-hand side, we have the age, and we have the IPP and the RRSP. We have 3 columns. And the goal of those 3 left columns is to show what is the contribution amounts that can go into the IPP. So at age 55, the person has been receiving a salary from their company. The person has been contributing to their RRSP. And one piece of information I should share with you is at this point in time, at age 55, the RRSP is worth $750,000 at that point in time. So at age 55, there's this past service calculation based on their earnings that this person has had historically in the company. And to get the program started, the actuarial does a calculation and then comes back with this number, $339,700 as the initial contribution amount for the IPP to kind of get it started based on the past service that the person has had. There are some options if someone doesn't want to contribute that amount, that they could choose a lower amount, but we're kind of looking at it on the maximum side for the purposes of the example. On the column to the right of that, the RRSP is basically fixed. The RRSP is basically saying 27,200 is the max that can go into the RRSP. And then as you work your way down those 2 columns, you'll see the IPP column in the age of 56 is now 40,000. The RRSP is 27,800. And you can see the difference will just get bigger and bigger because the IPP will allow for much larger contributions. So at the end, in total, around age 71, the IPP in our example has 1,625,600 contributed to it. The RRSP has 587,900 contributed to it. Now, we're going to move over to the columns on the right, the 3 columns on the right. And one assumption that is important for the purposes of this illustration is that $750,000 RRSP that the individual had at the start of the IPP. They are going to roll that into their IPP as well as the $339,700 initial contribution that they can make. So they're going to basically put all of that in to their IPP. One of the benefits of doing that is now the RRSP funds are inside of the IPP, and all of the investment fees on the IPP become a deduction to the corporation. Whereas if they stayed in the RRSP, they would not be a deduction to the corporation. So for that main reason alone, it becomes, a no-brainer that we want to move these funds over. So now you can kind of see the 2 columns on the right, the IPP and the RRSP, and you can kind of see over time what is happening in terms of the value, and the IPP values are getting further and further apart from the RRSP and higher, to the extent that at the end, at age 71, the IPP now has $4,983,900 in it, and the RRSP has $2,537,000 in it. So a very quick example or math that I did was the additional contributions between the IPP and the RRSP, the $1,625,600 versus the $587,900, that difference is about $1,037,700. So there's an additional, let's say, $1,037,000 that has been contributed to the IPP above the RRSP. So of course, there's going to be more money in that plan, but look at how much more there is. At the end of the plan at age 71, the difference between the IPP, $4,983,900 and the $2,537,000 in the RRSP, the difference is $2,446,900. So even though they've contributed about $1 million more into the IPP, because these investments are on a tax-deferred basis, so there's no tax being applied to them as they grow, and because of the way compounding works, the more money you have saved based on the investment returns, in our example, we're assuming 6%, it just grows faster and faster over time. So the bigger your balance that you have saved and the tax-deferred advantages, now we're just growing that balance more and more significantly. So we have 1 million more contributed, but we have almost $2,446,000 additional in value at the end. And that to me is really where the value lies in getting more funds into the IPP for those high income earners. So if someone is interested in getting started, there is a lot of fact finding that gets done. It isn't something that, I think as Nadeem mentioned, there isn't enough information in this presentation to be professional advice, just the basics. But normally what would happen in the clients that Nadeem and I would talk to, so, I kind of have an accounting and tax background, so I would speak to it from that side. Nadeem has the investment background, so Nadeem would speak to it from, the funds are being invested, what are they being invested in, what are those options? And then the actuarial, who would do the calculations of how much money needs to go into this plan, what are the amounts over time that can be contributed. And every, I believe, 3 years, the actuarial has to come in and do a analysis to see if the plan is on track. Is it underfunded or overfunded, and get that plan back on track. Like I mentioned, if the plan is underfunded, then an additional contribution might be an option. So it's basically information gathering that happens. There's a variety of pieces of information that would get gathered. Is the business owner on salary or not? What is their level of salary? What is their RRSP contribution room? What is their RRSP value? Things like that would be pieces that get obtained. What is their age? What is their planned retirement age? Things like that. The actuarial will get their hands on that information, put together a report, go over those projections with the client. And then if someone wants to go ahead, the actuarial would create the documentation and file that information with CRA and the provincial regulator to make this a registered plan. And now the company can start to make the contributions. All right, Nadeem, back over to you.
Great. All right, Jazakallah khair, sir, for that presentation. Like you mentioned, this is just a high-level understanding of what an IPP is. So we're going to start the Q&A for the webinar now. So I'm going to kind of start with the first question, I guess. Are IPP fees worth it? So
in our assumptions that we did, the IPP fees on the amount being invested is the same as the fees being incurred on the RRSP. Like we assumed 1.25% was the investment fee being charged. So we're assuming that both types, RRSP and IPP, have the same fees. So there isn't a change there. Now, where there is an additional fee is the IPP would require an actuary to do some analysis and some reports, depending on the complexity of that work. It could be a few $1,000s. So now we have to get into the consideration of, is that worth it based on, does the person plan to save more money? So if the person has a desire to save more money than what the RRSP allows, then usually, yes, the fees are worth it. And two, just by getting started into the IPP path, all those investment fees, the 1.25%, becomes deductible to the corporation, which is huge. That 1.25% inside of an RRSP is not deductible because it's inside of a personal registered account. So that is a huge win once someone gets their investments into the IPP.
Yeah, I mean, just to add to that, so, the actuary obviously has his or her fee, and that typically is a flat amount. And of course, the management of the investment, that would, like for example, like portfolio manager, the 1.25 that you said, and of course, any tax, any tax services that as well. And I guess all of that could be tax deductible to the corporation, correct?
That's right.
Okay, great. All right. Just a quick one here. Is IPP and CPP are the same? And if you want, maybe I can answer that.
Yeah, go ahead.
Yeah. Okay, so I guess you could say in the spirit of things, they are kind of the same in the sense that, when you're the CPP, you are contributing to the CPP. Every paycheck you look, you see that there's a CPP deduction, and then ultimately you do get a CPP when you retire. Now, with the IPP, and we didn't discuss this in the presentation, and maybe if there's a lot of interest, we can have an IPP part 2, is what happens, after you retire, right? There with the IPP, there are actually a couple of options here. Number one, you can decide to just simply continue the IPP and and have a lifetime income stream. And again, an actuary gets involved in terms of what that means and what those numbers look like. Or the other option is you can actually accumulate the value of the plan into a self-directed RSP, or I should say is going to be a locked-in RSP, something like a LIRA or a LIF. And in that case, and that tends to be the more popular option, in the sense that what you've done is at retirement, you've taken the cumulative value of the plan, and a good chunk of it is now moved over into an RSP or a RIF, and ultimately, you're self-managing that as well. So I've kind of answered that question, and I've opened a can of worms in terms of what are the options post retirement. Okay. Quick one here. If IPP is so great, how come it's not being used that much? Sarwar, you might want to answer that.
So the main issue, or the main difference that you probably noticed, is it requires a lot more money to fund. So some of our clients aren't able to max out their RSP. So if that's the position that you're in, you still have RSP room, you're not able to max that out based on your cash flow, based on your earnings, then the IPP might not be for you today. So a lot of times we kind of look at this IPP as a strategy when, for example, a high income earning doctor or professional hits a later stage of their career. For example, they've paid off their house, their kids maybe now are in university or past university. So now they've really hit a certain stage where savings is easier for them. And for a lot of people, if they're not at that stage yet, then putting, as you saw in the examples, putting that money aside in an IPP is a lot more difficult because it's higher than the RSP. So I would say start with the RSP first. And if that's not maxed out, then obviously there's some options there. And if it is maxed out and there's funds coming in and available, that's where the IPP really shines, is because it has a much higher ceiling for those high income earners that are saying, I need more options than just this RSP. I have too much income for that. And I will add one more point. The IPP is just lesser known. So a lot of people maybe before this presentation didn't even know what an IPP is. Like if I look at all the clients I have, there's probably less than 6 that I can think of that I have that have IPPs, but almost all my clients have an RSP. Maybe they have regular contributions, maybe they haven't used it in a while, but an RSP is just so common as far as knowledge goes, and IPP is lesser known.
Okay, great. Next question here is, can you self-manage your investments? And maybe I can tackle that. So, the IPP is a type of a self-directed plan. However, it is also subject to the pension legislation and some of the provincial rules, and so there are some rules that you have to follow when you're managing. So I think it's highly unlikely if most candidates, anybody who has an IPP is obviously in a category where they have a business that they're running. They have these are high net worth individuals that maybe don't have the time to manage this plan themselves. I've never seen it self-managing, meaning like a do-it-yourself online brokerage. I've never seen it, nor would I actually advise it. The second thing that I would add is that, with a firm like our ShariaPortfolio, of course, we're focusing on the Sharia compliant aspect of it. If you are looking to set up a halal pension, for example, this could be it, where we as the portfolio managers can implement that Sharia compliant aspect to it, right? So next question here is, okay, I'll give this one to you, Sarwar. Why not just leave all your money and invest in your corporation instead of using the IPP?
Oh, this is an amazing question. I should have talked about this actually. So the problem with that strategy, investing through your corporation, is multiple. One, investment income inside of a corporation is taxable. So you're going to have this tax drag on your investment income, because anytime you have a dividend, capital gain, interest, any of those things, it's going to cause you to have to pay tax. The IPP, the RRSP is tax deferred. So the compounding and the growth on that is much more significant because you're avoiding that tax. That's the first thing. The second thing, which is very relevant because of how recently it happened, was in 2018, the government introduced these rules on excessive and you know, it's a relatively low threshold investment income inside of a corporation that has active business income. So for example, there's a doctor, they're practicing, they're earning income. That income is considered active business income. In Canada, specifically Ontario, it's taxed at the very low rate, 12.2% for active business income up to $500,000. Investment income is taxed at a higher rate. And once investment income hits $50,000 or more, so that would be rental income, interest, dividends, capital gains, those types of income, the active business income, the $500,000 small business deduction actually starts to decrease. So we have this problem now where when these rules came in, it caught a lot of people off guard. A lot of people were just saving the money in their corporation. The old strategy for a lot of people was, if I don't need that money personally, leave it in the company. By leaving it in the company, I avoid paying personal tax, I invest it, it grows, and that strategy worked great. We had a lot of people doing that strategy for a number of years. And as soon as these rules came out, the business owners that had over $50,000 of investment income, now their active business income was being affected negatively, and they're paying a higher rate of tax on that. So now we saw and started to see a shift where people don't want that investment income in the corporation because of how it negatively impacts their small business deduction.
Okay, maybe a similar question here, or you can elaborate more, is I have been investing through my corp and using that as a retirement fund. Is the IPP a better option? If so, why? Maybe
yeah. So it's the same idea. So if you're investing through your corp, that's fantastic. That's a good way to use excess funds. But once your corporate investments hit a certain amount where they're generating more than $50,000 of investment income, and 50,000 is a big number on its own, but keep in mind, you know, if you're working for a number of years and you've built up $1 million portfolio, then 50,000 is a very, you know, manageable or normal number that you would hit. So now you have this issue with the active business income. And there's one more reason I can think of. If you build up an excessive amount of value in your corporation, in your investments, and now you plan to retire from your area of work, the money that you invested in is inside your corporation. For you to get that money out, you have to keep your corporation open. So you have this challenge now where the corporation needs to be open for the entire duration of your retirement, which means you have to continue to file tax returns. You have to continue to do the bookkeeping and the upkeep of it. So that's going to add costs to your retirement because the company has to stay open. Because if you take all that money out from the company when you retire, you're going to have a big tax bill. So the goal is you take it out slowly in your retirement, but that means your company stays open. With the IPP, it's an independent plan. You could choose once you've retired from your business and you don't earn active income anymore to close your company down. And as Nadeem was saying, your IPP, you have options. You can then push your IPP into a LIRA or a locked-in account and then start drawing down on it, but the money's not in your corporation. So that is another benefit, that you won't get stuck with this company for, you know, a number of years and now you have to maintain it. Because conceivably someone could retire at 70, they could live to 90. That's 20 years of corporate tax returns they have to keep filing to keep their company around. And obviously that would cause some fees that could offset the fees of the actuary and the fees to get the IPP set up, of course.
And also creditor protection. I think you forgot to mention that. That's,
oh, true.
Yeah. Okay. That's,
true. And yeah. I mean, by all means, we should elaborate on that. So if something happens in your company, that's a significant event that causes you to have a liability, you know, someone sues the company, someone is coming after the business, then having investments in your company is obviously assets that the person coming after you can come after, because those are assets of the company. An IPP is a completely separate investment, and it is not something someone who's coming after the company for, let's say, damages or suing you could come after, because it is separate. So yeah, thank you, Nadeem.
All right. Here's an interesting one. Can we contribute to IPP through a holdco? Funds from an opco transfer to a holdco?
Potentially. So the main thing is the person needs to be paid a salary. So there would be some specifics that need to be figured out. Is the salary need to be paid by the holdco, or is the opco okay? And it might be okay because there are some rules about associated companies. And if another associated company is paying a salary, then that might be okay. So the answer is possibly, but yeah, generally speaking, a group of companies that an owner has, like a holdco, opco, they're looked at together for the purposes of the actuary doing their work. So yeah, there's definitely a possibility.
Okay. Another one here is it worth it to pull money as salary to create RSP room if you don't need to spend all the money you pull out as a salary? Yeah, I get that right.
So I'm not sure of the question, but I'll just talk to those some points. Paying yourself a salary to generate RRSP room in this day and age, because of those investment income rules, is a good idea. So historically, people used to pay a dividend. A dividend was a little bit more efficient in terms of taxes because there's no CPP on it, but it did not create RRSP room. But the logic was the business owner only pulls out what they need, they invest the rest through the company. And that worked out great. These investment income rules came into play. Having too much investment income in the corp is a bad idea. So now over the last 2 years, the big shift that we've seen is moving back towards RSP, because even IPP aside, if we're just talking investing through the company or through an RSP, the RSP is much better because the RSP is tax deferred. So all those investments and growth is tax deferred. So you're not losing, you're not having the tax drag on your investment returns. So generally speaking, in this day and age, because of the tax rules on investment income, we are seeing people returning to salary and wanting to utilize the RRSP room.
Interesting. Okay. Just a quick one here from myself, I guess. Difference between RSP, CPP, IPP, and OAS. So I'll just kind of, break that down here. An RSP is what we call the defined contribution plan. That means that you are actually putting money in there and getting some type of a tax credit. And ultimately the investment risk lies with you, in the sense that when you put that money in and you invest it, that's more often than not, that's your investment risk. So if the funds do well, great. If they're like Sarwar's dad and he buys an hotel, they do bad, then that investment risk on you. Now, the CPP and the IPP, these are more defined benefits plan. In other words, these plans are designed to give you some type of a lifetime income. So with the CPP, you're putting money into the Canadian pension plan, and based on their formula, you are entitled to a certain amount, every month or every year or whatever, right? The IPP, it creates the spirit of that. I guess that's what the IPP is trying to do, is that create a pension. Not, the government's doing the CPP. This is IPP, which is on the private side. And so, it is structured in such a way to give you that lifetime income. But of course, there's a lot more flexibility with the IPP. For example, you can take the cumulative value on retirement. You can't necessarily do that with the CPP. And the last thing I'll just say about the OAS, again, that's old age security. That is just something that every Canadian resident that qualifies in terms of their residency and whatnot, they're entitled to. And again, that's not, you don't have to be working a day in your life in Canada, for you to be entitled to that. However, if I believe there might, again, this is not my specialty, but there could be clawbacks if you're making too much money in retirement, that you might not be entitled to that OAS. So I'm not too sure about that last point, but those are the three different explanations of those plans. So here one on IPP is, even if IPP fees are deductible, are you not still paying more money overall out of your pocket? I think you kind of touched on that earlier. I don't know if there's anything else you want to.
The answer is yes, because the IPP has the actuarial fees. So yes, you are paying more out of pocket. However, you're able to put more money into a plan that grows on a tax deferred basis. So really, you're spending a little bit more money to be able to invest a lot more money on a tax deferred basis. So that's the real advantage, is you're spending more to get access to more tax deferred investments. And normally, like in that example that we had earlier, those tax deferred investments will grow leaps and bounds more because of the tax efficiency to more than offset the fees. That's really where the advantage is.
Okay. I'm just gonna, a couple of questions here left. I mean, these are small ones here. I am 35 years old, newcomer in Canada. How can I take the monetary benefit of retirement planning and IPP? Maybe I can answer that one.
Sure.
You know, as you know, we mentioned earlier, the IPP, first of all, is somebody who is 40 years older. They've had past service, meaning they've had their corporation set up for a while. So there's, you know, there's money and capital built up there. So I'm not sure if the IPP would be something that would necessarily be a fit for you. You know, what we do, if you are new to Canada and if you are, you know, this is your first year you're working or whatever, you know, we obviously encourage you to build your RSP for the time being. You're 35 years old, so you're not, you know, depending on what you're doing, you know, the IPP may be a suitable fit down the road. But for now, I think, you know, typically, you know, starting with the RSP and just, you know, looking at what your contribution limit is, trying to take advantage of that. That's what you should probably do, because it does give you some type of a tax credit. And the last question that we have here is, if someone did CPP for 10 years and then started RSP with another employer, I'm not sure if that's a question or not, but I'll just kind of answer or address it anyways. I mean, the CPP is something that, again, like I mentioned, you know, it's guaranteed life income that you get that you're entitled to at retirement, and that money is based on, you know, a formula that the government, you know, does in terms of how much have you paid, et cetera, et cetera. Of course, you know, the CPP is not enough. Like the reality is, you know, the CPP is nice, but you know, typically, if depending on your lifestyle, it may not be enough. So that's why you should definitely have some type of a complement plan, like an RSP, or, you know, as we've presented here, the IPP, as something to really, you know, help you during your retirement years, inshallah. So with that, I think we don't, you know, we've kind of pretty much handled all the questions. If there are any other questions, or if there's any other topic or anything, Sarwar, you wanted to mention before we call it the night?
So in the main chat, Nadeem, there was one question by Mohammed, just for clarity on the 6 columns in the presentation. And I responded in the chat, and I just said we can share the case study and some of the information. We have that info from an actuary, so we can certainly ask the actuary if that's information that we can share. And if so, then we can pass that along in a follow-up to the attendees along with the recording. So that was one person's question in the main chat.
Okay, and I also see another one here. Can I open an IPP without having an RSP? And I think you answered that. The question is yes.
Mm-hmm.
So if you don't have an RSP, doesn't mean that you know, you can't start an IPP. And so that's it. I mean, Jazakallah khair, Sarwar, for your time and your excellent presentation. You know, our contact information is here. If you'd like to get in touch with either of us, you know, please, you know, feel free to reach out to us, and inshallah, you know, we'd be happy to help. If, you know, if there's positive feedback, and if, you know, we'd like, you know, there's more interest in the IPP, maybe we can do a part 2, but, you know, for the time being, I'd like to once again thank everybody for attending tonight. And, you know, we look forward to speaking and seeing you guys again.
Thanks, guys.
All right. Assalamu alaikum.
Assalamu alaikum.